So good morning everyone. Welcome to the class on investment management. We have discussed the risk and return for two asset portfolio and for three asset portfolio. In exam, they will not ask you more than that. So either they'll ask you problems related to asset or three asset. In last year also in 2019, you can see this question number 6, part B, 6 marks question came. So question number 6, part B, you can see a portfolio consists of three securities, one, two, three. The proportion of these securities are given to you, how much money you're putting in which security. The total proportion you know that is equal to one. The standard of returns, the standard deviation of return is given to you. Okay, the standard deviation given, the correlation coefficient is also, and they ask you what is the standard deviation. Gitanjali, switch off your webcam, Gitanjali. What is the standard deviation of the portfolio return? That is the question. So here, if I want the portfolio return, three stock portfolio is given. Their coefficient of correlation is given. Their standard deviations are given. So what you can do, you can find the covariance. You can find the covariance of them. You can find the covariance between 1 and 2, covariance between 1 and 3, covariance of 2 and 3. You can find their covariance, and then you can apply the formula. Remember, they are asking you the standard deviation. So whatever the answer you get, you have to do the square root of that. So the standard deviation of this portfolio, this is what you are getting. This is the variance of the portfolio. This is what you are getting. This is the variance of the portfolio. This is the variance of the portfolio. If you want the standard deviation of portfolio, so that will be the square root of W1 square sigma 1 square plus W2 square sigma 2 square plus W3 square sigma 3 square plus 2W1 W2 covariance between 1 and 2 plus 2W1 W3 into covariance between 1 and 3 plus 2W2 W3 into covariance between 2 and 3. This is the standard deviation of the portfolio. So I hope you understanding this. Okay. Anybody have any doubt? They feel free to ask me. Like if you see this question number 8, if you see this question number 8, already we have done questions like this in the past. If you see question number 8, here they are given you the returns of two assets under the four situation. They are given you the probability. They are given you the returns. So what is the standard deviation of the return of 1 and 2? So I hope you remember that whenever the historical data is given, so whenever the historical data is given, whenever historical data is given, whenever the historical data is given, so with historical data, if you want to calculate the standard deviation, with historical data, if you want to calculate the standard deviation, formula is x minus x bar whole square by n, or your formula is square root of summation of x square by n minus x bar square. So you can use this formula for standard deviation when historical data is given, but when the data is given in probability, when the data is given in probability, when your data is given in probability, so then what is the formula of standard deviation? So you calculate the standard deviation by the formula summation of pi into ri minus er whole square, where er is called expected return, which you get by the formula summation of pi into ri. So with this, you get the expected return on the portfolio on the, so individual here. I already we have done in numericals on this, so you can easily find the standard deviation. You can easily find the standard deviation. So this is the formula when the data is given in probability. The formula for standard deviation, while the covariance between x and y when it is given in probability is the summation of pi into rx minus erx into ry minus ery. This is the formula. This is the formula of covariance when the data is given in probability. So this is the formula of standard deviation. So what you can do here, you can easily find the question number 8. I hope you can see. You can easily find the standard. You can easily find their standard deviation of this asset 1 and asset 2, the return on asset 1 and asset 2. You can find the covariance. Already I told you the formula of covariance. Now once you get the covariance, they're asking you what is the coefficient of correlation. So you can find the coefficient of correlation. Coefficient, to find the coefficient of correlation, you have to divide the covariance, whatever you get of x and y, that you have to divide with the standard deviation of x and standard deviation of y. So these all are very easy problem. You can easily solve them. Okay. I don't think anybody will have any doubt. Anyone want to ask any question? Anyone have any question in their mind? Okay, now I hope you don't have any doubt. So see what happens whenever we talk about stocks, whenever we know that any company who have done the IPO, once the IPO is done, once their stocks are listed on the stock exchange and the trading is happening on the stock, you buy and sell the shares depending upon the performance of the stock in the market, what you feel about the stock, how the stock will work. Based upon that decision, what you do, you buy or sell shares in the market. So that is the perception about as a trader, that as an investor, when you buy or when you sell the stock, so we do fundamental analysis, we do technical analysis to analyze the stock, how good is the stock for the investment. So we'll discuss about fundamental and technical analysis in the future. Like I'll show you, you go to this money control website. If I go to money control website, I can suppose if I want to track Infosys, suppose I want to track the performance of Infosys. So suppose if I want to track the performance, so you can see Infosys today is trading in negative. You can see that on BSE it is trading at 1,112.65. It fall down by 23.45 rupees. It's fall of 2.06%. So now you can see NSE it is trading at 0.50. So you can see that yesterday it has closed for 1137 and now it is trading at 1109. So you can understand the stock is falling down. So that, yeah, the news what all came yesterday, so that news were negative about this stock Infosys, because those stocks were negative, because those news were negative about this stock, because of that news the stock price of Infosys is keep on falling down. So if I see such kind of movement in any stock, so this movement you can predict before, because if you are aware about the stock market changes, you know that the news what comes about the company, the news what comes about the sector, or the news what comes about the country, those news directly or indirectly, they are affecting the stock market performance of any particular stock. So we need to track the news what happening around the world, because our Indian stock market will close down around 3:30, and then once our stock market close down, then only after that US market opens. So whatever gonna happen in US market on today, that gonna affect our market tomorrow. Okay, so probably around 12 o'clock in the noon, the European market used to open. So as per the Indian timing, so the gradually around 12 o'clock you will see lot of volatility in the Indian stock market. The time when the European market is about to open, before our market opens every day at morning 9 o'clock, before that uh, before our market opens every day in the morning, before our market, what happens, we see the Chinese market, Hong Kong market, we see Taiwan market, so they opens our before our market. So what you need to understand, whenever you want to track the performance of any stock, whenever you want to track the performance of any stock, what you need to do, you the moment you the moment you get up early in the morning, the first thing what you need to do, you need to see what is happening in the Chinese market or Hong Kong market or Taiwan market or Singapore market, and gradually you need to have an idea about what has happened yesterday with the US market, and then gradually you can develop an overall idea about what is going to happening on our market today. So see, understand, whenever you trade in the stock market, their prices goes up or down, but you can predict that prices. Normally in stock market you buy first and sell, and then you can sell it later on. But there is a strategy in the stock market that is called short selling. There is a strategy in the stock market that is called short selling. So in the short selling, what you can do, you can sell the stock first and you can buy it later on. That is called short selling. So when we talk about short selling normally we do when the market is bearish. Short selling basically we do when the market is bearish or pessimistic. So whenever the market is bearish or pessimistic, whenever pessimistic or bearish means you know that it will fall down, when you know that it will fall down. So when you see a bearish or pessimistic market, what you can do, you can sell the stock first and you can buy it later on. Okay, so because if you know, if you see the Infosys that is keep on falling down, if you see Infosys that is keep on falling down, so because I know that today the Infosys will keep on falling down. It will fall down by 30 point or 40 point. So what is the best case strategy would be? The best case strategy would be you can sell the stock first and you can buy it later on. That we called as a short selling. So that is called short selling. But short selling you cannot do beyond a day. So it's not like you can do short selling for 2 days, 3 days, nothing like that. So whenever you do short selling, whenever you are doing short selling, the purpose of doing short selling is that whenever you work on short selling, you have to make sure that you do short selling, and whatever you sold first, you have to buy it later on within the end of the trading day. So this kind of strategy you can apply whenever you see some kind of stock which have the possibility of falling down. So remember the concept of short selling. Generally, as in when we do investment in the stock market, whenever we put our money in certain stocks. So as an investor, what we are looking for. So as an investor, what I am looking for when I am doing investment in the stock market. So as an investor, the return what I'm looking for, the return what I'm looking for in the stock, that return is either in the form of dividend. So some people invest their money on stock looking for dividend. So some people look for a return on the stock in the form of dividend. So so that return on dividend what you're looking for, that we called as dividend yield, plus the return on investment what you're looking for, that we called as capital appreciation, so as an investor what you are looking for whenever you invest in the market, either you look for some value what the company will give you at the end of every period, that we called as dividend. Okay, so what is basically a dividend yield? What is basically a dividend yield? What is basically a dividend yield? So dividend yield basically means the total dividend paid by the company. Total dividend paid by the company. Total dividend paid by the company in last 1 year. Total dividend paid by the company in last 1 year total dividend paid by the company in last 1 year divide by the average market price divide by the average market price of the share divide by the average market price of the share into 100. So this is called as dividend yield. So dividend yield basically means the total dividend paid by the company in last 1 year, the total dividend paid by the company last 1 year divided by the average market price of the share. This gives you a value, that value we call as dividend yield. So many people when they do investment in the stock market, they do investment looking for a value. That value we called as the dividend. Okay, so many people they simply invest their money in the stock market looking for dividend. They don't want anything else. But I hope you know that a payment of dividend is not the compulsion for the company, while the payment of interest is the compulsion for the company, that either the company get a profit or either the company get a loss. The company either the company get a profit or either the company get a loss, the company has to pay interest. Okay, so that's why whenever you take money on debt, so that you're taking a risk. That risk is called as financial leverage. So whenever you take money in the form of debt, you are taking a risk. That risk we called we called as the financial leverage. We call that risk as the financial leverage. That risk you get that risk you get because whenever you borrow money in the form of debt, the payment of whenever you borrow money in the form of debt, the payment of interest is the compulsion for you. Okay, so that's why that debt is considered to be risky instrument. But you know that in the case of in the case of equity, in the case of equity instrument, you give ownership to the other individual. So in case of equity instrument, the payment of dividend is not the compulsion for the company. If the company want, they will give dividend. If the company does not want, they will not give dividend. So payment of dividend is not the compulsion for the company. So I hope you're understanding. So whenever the company get a profit, whenever the company get a profit, this net profit, profit after tax. So certain part of dividend they pay to the shareholder if they want. Otherwise, it's not a compulsion for them. And remaining part which they retain with themselves is called as retained earning. So the remaining part which they retain with themselves is called as a retained earning. Okay. So now this retained earning, what they have not given to the shareholder, so this retained earning they'll put in their reserve and surplus account. This retained earning they will put in their reserve and surplus account. So they try to continuously accumulate retained earning in the reserve and surplus account. So and that way, what they try to do, they are trying to increase the internal equity of the company. They're trying to increase the internal equity of the company. So tomorrow, if the company need money, then company don't have to dependent on outside for the money. Are you getting me? I hope you are understanding. The saving, like internal equity is like a saving of the company. It is a saving of the company that tomorrow if the company need money, they will not figure out external financing either by equity or either by debt to raise money. If the company need money, so what the company will do, they have enough reserve and surplus, so they can use the reserve and surplus during that time of whenever such kind of contingency situation comes, because the payment of dividend is not the compulsion for the company. So the part of earning what they'll retain, that we call as retained earning. This retained earning they'll put in the reserve and surplus account. Reserve and surplus account is the part of net worth or the book value of the account. So this reserve and surplus, the sum total of reserve and surplus plus a share capitalization, the ordinary share capitalization plus preference share capitalization in balance sheet, we call that as a net worth or the book value of the company. So the net worth is very important is very important parameter. So if you keep on accumulating reserve and surplus, you keep on accumulating every year retain earning. So and that way you will increase the net worth. That how you'll increase the net worth or the book value of the company. That how you increase the net worth or the book value of the company. That how you will increase the net worth or book value of the company. So net worth or book value of the company, that we represent, that we represent as a sum total of share capitalization, ordinary share capitalization plus preference share capitalization plus reserve and surplus reserve and surplus reserve and surplus. So this will give us the net worth or the book value of the company. So better is the net worth or the book value of the company. It has more chances that the company will sustain any kind of economic turbulence if suddenly if gonna affect the company. So net worth or book value talks about the strength of the company. If you remember, Satyam Satyam Computers, when Ramalinga Raju, when he declared that he was doing fraud, he declared why he was doing fraud. So he is strengthening the fund of the Satyam Computers in his son's company, Mehta's Infrastructure and Mehta's Properties. So that all happened because of reserve and surplus only. Because what Ramalinga Raju used to do, whatever the end of the day, the profit the company used to get, Ramalinga Raju in reality used to take out that money and use that money for his son company's development. But as a public company, you cannot do that. Satyam was a public company and you cannot use the public money for your own son's benefit. So Ramalinga Raju was trying to do the same thing. So what Ramalinga Raju used to do, he used to increase the cost of the company and all. So thereby he wanted to reduce the profit of the company. On accounting part, I'm telling you, in reality it was not happening. In reality, till the end of the day, so there's no problem with the Satyam business or the office, their client. Everything was very good with Satyam. Only thing on the paper, Ramalinga Raju used to do lot of accounting mismanagement. So where he used to take out the money of the company for his own purpose, and that he can't tell to the investors because Satyam was a public company. So what Ramalinga Raju used to do, he used to increase the cost. So by showing us the increased data of the cost, his objective was to reduce the profit, thereby to reduce, if the profit would be reduced, then anyway he is not going to pay to the dividend or retain earning to the shareholder, and ultimately what would happen, ultimately he can use that money easily for the son company. But gradually he was not giving any dividend to the shareholder. Gradually these data keep on accumulating, and Satyam had a huge reserve and surplus in their balance sheet. But Ramalinga Raju in reality does not have that money because all the money Ramalinga Raju was using for his son's company. In order to cover up the data, what Ramalinga Raju did, he tried to uh, acquire two companies which were not known to the public, called Mehta's Infrastructure and Mehta's Properties. So with that money, what he had in balance sheet, in the net worth or reserve and surplus account, he tried to use that money to buy two companies. Those were Mehta's Infrastructure, Mehta's Properties. So thereby he made the investors or board of directors furious because they were not understanding why at the time of 2008, what you say, meltdown, when economic crisis was there in 2008, why Malinga Raju is interested to buy two infrastructure-based companies, and because infrastructures are risky investments, their returns are not guaranteed. Means a high risk, high return. Infrastructure companies are like that. So if you use Infosys is an IT company. So if you use the reserve and surplus of an IT company to buy two private infrastructure-based companies, no one was understanding why Ramalinga Raju is trying to do this, and ultimately, when everyone opposed, then Ramalinga Raju left with no option. He has to tell to the public that he was doing fraud, and he was using the money for his own son's company, and in reality he don't have any money which is shown in their balance sheet. So that was the incident what has happened. So if you good net worth or reserve and surplus for the company, so that is good for the company in the long run. That gives that shows the confidence of investors on the company. So whenever you do investment on the company, you should consider a ratio. You should consider a ratio whenever you think of doing investment on the company. The ratio is price to net worth ratio, or price to book value ratio. If you see any company, which has very good price to book value ratio, so then you can consider that company for investment, instead of many people look for P ratio instead of P ratio. P ratio means price to earn ratio. So price to earning ratio is not the better judgment. In price to earning ratio is not the better judgment to analyze the stock whenever you go for investment. Better than price to earning ratio, you should look to price to book value ratio, because you need to understand earning. When I talk about earning is what? Net profit. Earning is the net. What is earning? Earning is the net profit of the company, and that net profit of company you can get by doing lot of accounting adjustments. So earning does not talks about the cash position of the company. I hope you understand, because if you see profit or loss statement start with revenue. Revenue can be in the form of cash, it can be in the form of credit. Then you have depreciation, you have amortization, you have interest. So you have lot of entries which ultimately will reduce the earning of the company. So because the depreciation or amortization, they are non cash expenses. Okay, so you can follow any method of depreciation, and by that you can do lot of accounting. You what you say up what you say mismanagement. Thereby you can change the depreciation amortization, and thereby you can change the profit of the company. The idea is to reduce the taxes. Many companies do that to reduce the taxes and all. So earning does not reflect the true nature of the performance of the company. So instead of looking for P ratio, many investors go for P ratio. Instead of looking for P ratio, you should prefer price to book value ratio. So that will give you a better judgment whenever you are talking about the analysis for the stock. You need to understand that the shares, when you talk about shares can be ordinary share can be the preference share. In the case of preference share, the payment of dividend is kind of compulsion, not a compulsion, but probably whenever the company get a profit, the company gives dividend for the preference shareholder. But for the ordinary shareholder, the payment of dividend is not at all a compulsion. If the company want, they will give dividend, but if the company don't want, they will not give dividend. So this dividend divide by the profit after tax, that is called as dividend payout ratio. Dividend divide by profit after tax, that is called as dividend payout ratio. This is called as dividend payout ratio. While retained earning divide by profit after tax, retained earning divide by profit after tax, it is called as retention ratio. Is called as retention ratio. So remember that the sum of dividend payout ratio, sum of the dividend payout ratio, the sum of the dividend payout ratio plus retention ratio. So the sum of dividend payout ratio and retention ratio, the sum is equal to 1. The sum is equal to 1. Okay. Anyone have any doubt? Any question you want to ask? So better the retention ratio of the company, better is the possibility of the growth. So whenever you measure the growth of a stock, whenever you measure the growth of the stock, we measure with a formula. Is retention ratio. We measure with a formula called retention ratio into return on equity. So whenever we measure the retention on a stock, whenever we measure the growth on the stock, we measure with a formula called a retention ratio into return on equity. So this is the formula to measure the growth on the stock. So we measure the growth of a stock with the formula called retention ratio into return on equity. Return on equity means profit after tax divided by the net worth. What is return on equity? I hope you remember the ratios and all. So return on equity formula is profit after tax divided by the net worth or the book value of the company. That is called return on equity. Retention ratio is retained earning divided by profit after tax. So if you multiply them, you get the growth of the stock. So as an investor, you need to understand many investors don't prefer to invest in such companies which gives them dividend because whenever the company gives them dividend, then the company is reducing their chance of growing in the market. So many investors who go for stock market investment, they don't like such companies which give dividend. They prefer to invest in those companies which does not give dividend, because if they will not give dividend, then more and more will be your retained earning. If you have more and more retained earning, so that more and more retained earning will create more and more reserve and surplus, and more and more reserve and surplus will create a more and more net worth or the internal equity of the company. And when you have a better internal equity of the company, automatically you have more possibility of growth. So there's more possibility of capital appreciation. I hope you are getting the logic. So, but keeping too much net worth or internal equity or reserve and surplus is not ideal for the company, because there's an inflation which reduces the value of your money. So I told you at the beginning of the class we should always go for investment. So we should always look for investment, and the purpose of looking for investment, either for an individual point of view or either as a company point of view, is to make sure that your value of your money does not get eroded because of depreciation. Depreciation is like a rust. So it is not the rust of ferrous oxide or ferric oxide. It is not the rust which happens in the form of oxygen in the atmosphere. It is a rust. Depreciation or inflation. What inflation basically do? Inflation, it reduces the value of your money. So keeping money idle, either for individuals or either for a company, is not a very good investment decisions whenever the investors look for return in the market. So basically when we do investment in the market, so how you can do the valuation the problem happens, how we can talk about the valuation of equity share, how we can talk about the valuation of ordinary share. That is big problem whenever you do investment, valuation of ordinary share. Because because here in the case of ordinary share, the the in the case of ordinary share, you know that ordinary share follow a going concern concept. So because the ordinary shares follow going concern concept, because of which once a share is being issued in the market, this share will have infinite life. The management of the companies will keep on changing, but the ownership the ownership right for the share will not change. So once the company have done the IPO, once the IPO of the company is done, then the company will when then the company start trading, and then the life of the share what you have bought either from IPO or either from secondary market will have infinite life. So the valuation of ordinary share itself is a very complicated exercise. You cannot determine the value of an ordinary share uh, for for maximum possibilities, because in the case of ordinary share the payment of dividend is not fixed. The payment of dividend is not fixed. Then at the same time, in the case of ordinary share, whenever we talk about ordinary share, at the same time, in the case of ordinary share, whenever you talk about ordinary share, similarly, in the case of ordinary share, whenever you look for ordinary share, the life of the share is not defined, so they have infinite life, and the possibility of dividend is also not fixed. So investors normally don't prefer to invest in such companies which give dividend. There are some companies which are known to give dividends. So if you are some kind of investors who get happy whenever you get dividend, then you can go for such kind of stocks. Otherwise otherwise for general investors, they who don't much value dividend, because for them capital appreciation matters a lot. So for them, considering dividend is not something which they should feel happy about. So for them capital appreciation matters a lot. So basically an investor, whenever they do investment on the market, they either do investment considering dividend, or they do investment they considering the capital appreciation. But I believe majority of the investors go for capital appreciation, because more and more earning the company retain with themselves, more and more earning company retain with themselves. You know the effect of compounding. More and more reserve and surplus the company will build, and more reserve and surplus if the company is building, so there's a more chance, there is more chance that the value of the company will increase, that the company will save themselves from any kind of turbulent situation. You heard of Lehman Brothers 2008, when Lehman Brothers got bankrupt. So Lehman Brothers was in very good shape. Lehman Brothers was the world fifth largest investment banking company. Lehman Brothers was present in every countries in the world. But even then, in 2008, Lehman Brothers got, the reason was not that Lehman Brothers had any problem. The Lehman Brothers had very good the asset value of Lehman Brothers. If you check, the asset value of Lehman Brothers was very good. The problem with the Lehman Brothers was the liquidity management. So they have taken lot of debt from the market. Their ratio was 1:33, debt to equity ratio or liquidity coverage ratio. So because they had assets everywhere in the market, but they don't had liquid assets. So because they don't have a very proper liquid asset which can save themselves from the contingency situation, and because of which they end up in with a situation where they end up in getting bankrupt. Imagine you have lot of money, and all your money what you have earned, all the money you have invested in gold, or maybe in some lands, or maybe in some investment product where withdrawing money is very difficult. Imagine you have lot of money, but if you have invested your money in land or gold, or public provident fund or national savings certificate, where your money get locked. Once you have done investment, your money get locked. Now you cannot withdraw the money, and suddenly tomorrow you need certain amount of cash upfront, very emergency, for some medical purpose or anything. Then in that situation, even then you have lot of money with you, but even then you could not able to use the money. The is that the improper management of liquid fund. So because it is very important that for a company, they need to have appropriate liquid funds. Liquid funds means either quick assets or current assets. The current assets are in the form of current assets in the form of cash, account receivable, prepaid expenses, inventory, all that, which can be the form of current assets. it is important that the company should have appropriate amount of current assets. The current ratio should be good, or liquidity coverage ratio should be good. So ultimately, then only the company can sustain themselves from any kind of turbulence in economic market, because there are certain kind of risks which we can minimize, which is called unsystematic risk or concentration risk. But there are certain forms of risk which can never be minimized. That is called market risk. So market risk can never be minimized, no matter what logic we follow in the market. Any events like right now, Armenia Azerbaijan war is happening. Because of Armenia Azerbaijan war, Pakistan, Turkey all have entered already into the war. Now Russia is planning to enter into the war. So once the Russia will enter, then maybe the other NATO countries can also enter into the war. And then because of US election, US is not taking interest. Tomorrow US may also will enter after the election. So what will happen again? This the issue of Armenia and Azerbaijan can become the next Syria. So such in order to protect ourselves from such kind of turbulence, economic turbulence, because if there's war which is happening in any part of the world, definitely is going to affect us either directly or indirectly. So you need to understand the part that as an investor, there are some form of risk which you can minimize, which is called unsystematic risk by using portfolio diversification. But there are certain risks which can never be minimized. Those are called market risk, which is always there in whenever we talk about investment in the market. That is the idea you need to understand. So I hope you have understood what all we have done so far. Anyone want to ask any question? Anyone have any question? Anyone have any question?